Hello and welcome to iGlobal, the great big Indian money show. This session is trading places, investing in gold, commodities, and currency. My name is Nili Joshi, and I'm a digital entrepreneur based in London. I have been in these markets for the past 3 years now, and I actually specialize in helping people make money from home through different streams of income, such as trading, cryptocurrency, drop shipping and e-commerce and plenty more. So this session, I'm actually going to introduce our panelists for today. First of all, we have Arya Kawari, who is a founder and managing director of FutureBricks, a fintech property investment company. We are talking about someone who has literally had an interest in investing for a very long time now. She started her entrepreneurial journey and found the company FutureBricks, and currently has a total portfolio to date reaching over 3.4 million in over 18 different projects. Secondly, we have Vatsal Garg, who is a retail portfolio manager and manages portfolios for investors in India under the message Enigma Capital. He invests in Indian equities and also deals in macro trades through his virtual portfolios. And last but not least, we have Mr. Sanjeev Shah, who's the Chief Investment Officer of the Sun Global Investments Unlimited. This is an individual whose investments include the global fixed income markets. He is also a portfolio manager for client managed accounts and in asset classes ranging from bonds, structured products, and global equities. We're going to be having a conversation with these panelists today about trading in the currency and commodity industries, and we're going to go ahead and get started. So my first question to all of you is, first things first, is what alternative investing platforms are prominent out there that investors should consider? I think we'll go with ladies first. So I'm going to ask Arya to please unmute yourself.
Hi, thank you for having me on the panel. I slightly come with a different agenda on the table. So FutureBricks, our company, what we do, we are a peer-to-peer lending platform for small and medium-sized house builders who don't get access to finance. At the same time, it's a platform where retail investors can invest as little as £500 and get up to 10% interest per annum. A lot of our projects are also give monthly interest. So, our platform is seen as asset-backed investment. Capital is at risk. It's not covered by financial compensation scheme. So to answer your question in terms of retail investing is that investing in property in general was seen something as exclusive club. You need a lot of capital to invest in, but with the advent of technology, we basically allow even like retail investors as little as £500 to invest and create like a steady passive income stream which is backed by bricks and mortar. So that's basically where we come with a different point of view on this panel.
That's amazing. So just to clarify, you're looking more from a property perspective as opposed to a trading perspective in itself. So you're looking at a return on investment through property. Is that correct?
That's exactly right.
Okay,
yes.
okay, amazing. And just another question for you, Arya, out of curiosity, what would you say are the common property investment platforms that are out there that a new investor or someone who's looking into investing to actually should be looking at? What would you say to that?
Yeah, I think there are two types of property platforms that are out there. One is the buy to let, so that's like property crowdfunding, and then there is this debt-based property funding, which is where we come into. So the difference between the two is that one where you can invest in an actual piece of property. Maybe you have another 90 co-investors, and then you get a rental yield, and then when you sell the property after 3 or 5 years you can if there are any capital upliftment you can get that. So that's the buy to let crowdfunding model. Usually rental yield is maximum up to 7%, and whereas the property debt based platform such as FutureBricks is a short term investment. So it's like the average loan term is 6 to 12 months. You're not investing in a physical property, but it's asset backed because you're funding like the construction of these projects. So these are like the two main different kinds of property platforms out there for retail investors. The debt-based platform can provide you ISA as well, so you can use your ISA wrapper to invest in on these returns. And whereas the crowdfunding, the property platforms doesn't provide ISA. And yeah, as mentioned here, like both the platforms carry capital at risk. Yeah.
Okay, fantastic. Thank you so much, Arya. Next, we're going to go to Sanjeev. So Sanjeev, of course, you've been in this industry for over 40 years now in terms of trading and actually investing. So what would you say is, well, how can one person learn about the alternatives to trading? Of course, you've been in the game for a very long time. How can one actually learn about the alternatives to trading in currencies and commodities to actually get a better return on investment? Where would one start?
Well, the good news is that compared to when I started, there's a lot of information on the internet. There's a lot of websites and places where you can learn about trading, about the pitfalls and the mistakes you can make. Our business is to advise clients, and we give them access to the biggest platforms, which is the global foreign currency market and also the global stock markets, and the derivatives, which are based on those indices. We can also give access to the commodity exchanges, such as the Chicago Exchange or wherever the derivatives are traded. But for UK retail clients, there are a lot of other platforms today, some of which have already been mentioned. Obviously, there are the spread betting platforms, which have been around for a long time, but there are many new platforms, including Interactive Brokers and others. So I think there is no shortage of platforms. But I think one of the things I say to people who are relatively new is spend as much time as you can learning about it before you start trading and actually risking your capital. If you look at the advertisements for people like City Index and IG Index, they often say 70% of our retail accounts lose money. That means if you start trading, you are going into activity where the average retail investor loses money. So you have to be very, very careful and pay particular attention to risk management, stop losses, position sizing, and so on, in order to make sure that you are one of the 30% who makes money, not the 70% who loses money.
100%, Sanjeev. Thank you so much for your answer. So just to kind of go off that point that you just made, like you said, there's so much more information out there today in terms of where to invest, how to start investing, a lot of different platforms as opposed to when you first started many years ago. What would you say is the downfall to that? What would you say are the pitfalls that people lose into? Why is it that 70% of retail traders lose when they first start learning how to invest? What is it that they fail to understand, or what is it that is the missing piece of the puzzle that people need to understand is so important? What would you boil it down to?
Well, I think it's risk management, knowing what you're doing and managing your risk, knowing the risks you have, not being overconfident, not over trading. And these things have always been there. In terms of the pitfalls, the biggest problem we find now compared to 2030 is just information overload. There's so much information you have, so much news coming at you. And often a lot of the news, especially in the markets, is designed to panic you. It's designed to make you do something, activity. Because remember, stock exchanges and the brokers who serve you, they don't make money unless you trade. So their business is not whether you make money or lose money, but that you're active. So one of the biggest things to learn, which is not to do something, because the market will always be there tomorrow and next week. There is no reason to rush. Take your time, do your analysis, think, and even after you've done all that, you don't have to do anything. I mean, I'll give you one statistic. We research companies as fundamental long-term investors, yet 9 out of 10 companies that we do a lot of research on, that means spending 10 days, 20 days of time, we don't invest in because we decide for whatever reason it's still not the right time. So, if you're going to make money, then be aware of the fact that other people will only make money if you do foolish things. Foolish things you can do is trade too much, overtrade.
Thank you so much for that answer. I think that's definitely given a lot more clarity for new traders as well. And last but not least, Sanjeev, how would you say someone can actually, with this whole information overload, there are unfortunately a lot of people out there just out to get people's money, out to just, have new retail investors investing $10,000, $15,000, even sometimes it's about as much as $20,000 in order to be able to, in inverted commas, flip that money, when I think we pretty much all know that something like that, it probably sounds along the lines of a scam. So what would you say to a new investor to look out for when it comes to looking for scams, looking out for the right investors, and whether or not it's better to invest into someone to make the money for you or actually learn yourself? How would you say someone can avoid this?
I think you're right. There are a lot of scams every day in the newspapers. There's examples, and the regulators like the FCA are fining people or failing to catch them and so on. So you have to be very, very careful. It's your money, and it's a very dangerous world out there. Obviously, from our business, so my answer is a little bit biased. We are advisors. So I would say that find somebody who can advise you, who you trust, and you build a good relationship with, a long-term relationship. And a very good advisor will often tell you not to do something. They'll say, look, I know a lot of people are telling you to do this, but for this, and this reason, it doesn't make sense for you. Don't do anything. And that's the sign of a good advisor. When you do something. So if they're telling you not to do something, there's a chance that they really do have your best interests at heart.
Fantastic, fantastic. Thank you so much for that. And Vatsal, thank you so much for being on this platform. So I just wanted to ask you, when it comes to trading, you've been trading for a number of years now as well. For an average retail investor, do you need a large amount of capital in terms of what you do when considering these alternative platforms? What would you say is a decent amount of capital for someone to start off with? Is it really what the myths say about having to start off with a lot of money, like Arya mentioned, or is it the case where sometimes you do have to have a bit more capital? Can you shed some light on that?
Sure. First of all, thank you for having me. It's a great platform to be. Coming back to your question, I think it depends on the strategy that you're pursuing. Like the strategy that we pursue, we basically do our fundamental research, and then we try to buy the stocks that we have at least 6 months to 9 months of risk to return reward ratio in our mind. But here's a story, and it's a real one. I used a fifth of my fund, and I bought stock of a company called Trident Corporation. It's basically it's a textile industry, and we bought the stock at 9, close to 9 to 10, and I'm talking in INR, Indian rupee. I did my research, and I came across this what you call as inference that this stock is highly undervalued, and we did our research, and finally I mailed the CEO a memo, and I told him that there are 5 to 6 things that we can actually change, and he didn't reply, but I'm sure he read that mail, and finally within next week he actually took one of those steps, not all the 6 steps that we outlined, but one of them, and stock shot up 35%, and according to my research, it was pretty, like, I wouldn't say overvalued, but sufficiently valued, and we liquidated our position with 6 to 7% of gain. So this is basically what you call as activist investing, where you are actually, using your money, getting an influential stake in the company, uh, talking to the investors, talking to shareholders, management, some proxy fights. But there again, in this strategy, you need a lot of money. Whereas in case of a first basic strategy, what you call as vanilla investing, typical long short strategy, you can start with small amount of money, but then again, you don't have the kind of influence to the CEO. Like in my case, I know I did my homework good. We made 34% return on our position. I know I did my homework pretty good. I knew that the undervaluation of the stock made a lot of sense, and I shot the email to the CEO, but he didn't really care to reply because the kind of money that I was dealing with was very less. Whereas if it had been some big hedge fund guy or some big institutional investor, CEO would have definitely taken some real interest in the other 5 options that we had in our mind. But it's all right. So coming back to your question again, I think it depends on the strategy. What was the second part? This question.
No, thank
Hello?
you. I was just going, hi, can you hear me? All good?
Sure. Yeah.
I just
Yeah.
wanted to ask as well, when it comes to your trading and,
Mhm.
of course, when you're working with people, how would you say has been the way in which you've been able to manage your emotions? I think when it comes to trading, a lot of people fail to realize that it is to do with a lot more 90% psychology and 10% skill set. It's really all about actually understanding how to control your emotions through correct risk management and to really balance out and control, people's greed. We're humans, it's our own money at stake as well, which can really have an emotional impact. What would you say that you did throughout your journey to be able to help you curb those emotions and really become logical when it comes to trading?
Absolutely. So, very nice question. And I totally agree. I think in this investing game, even in speculation game, EQ matters more than IQ. Other people handle you and you handle other people matter more than, you're just doing mathematics and statistics. So a little bit more context about how I did. I think first advice that I would give to anyone who's trading or investing or whatever is, do not day trade, do not intra trade, and definitely don't do it with leverage. I mean, we were up some 28, 34% within 2 months, and we just came down to 4 to 6% within 2 weeks. Why was it? Because I lost my emotions, I got greedy, and I day traded, I intra-day traded, and that too with leverage, and I lost quite a lot of capital. And we are still in the red, I think. Although our investing portfolio, we are back to our investing strategy, and I think we are making money now. But so I think emotions definitely they matter a lot. Second thing, and I think this is more important than anything, is that whenever you're losing money, so instead of just panicking and doing your panic selling, so markets they just overreact for a day or two, maybe a week. But if you hold on to a position and if you're emotionally very strong, you actually buy the dip. So I think you're going to make a lot of money. But then again, that's investing paradigm instead of speculation paradigm. So emotions matter a lot. I think they matter way more than your simple mathematics. The fundamental research pretty much the same. You go with the same ratios. You have your own industry. You have your own sectors, asset class, and once you're done with that, basically it's the emotion games. So yeah.
Fantastic. Thank you so much, Vatsal. Okay, and I have
Sure.
another question for Arya as well, considering we're talking about property. How would investors balance out the risk factor by investing into property? Of course, we were talking about the capital to actually get started and the risk that's involved. How would investors learn to balance and actually manage and be aware of this risk?
Yeah, I mean it's important to first do the research as a any sort of investors, whether retail, high net worth, or sophisticated, and to understand that it's the disposable capital, which is also at risk. But the main thing is to understand that. So even in the property, you have different types of security. So you have like first charge holder. They look at the LTVs. So, for example, on a platform or like loan to values are capped at 65%. We take first charge, we take personal guarantees, debentures over the SPVs. We have a full underwriting team. So, any investors is able to see all the reports like from the valuations and, risk categorization and so on. So for us, it's very important that it's completely transparent. And the whole idea is to start small, and it's a different kind of asset class. So stocks and shares has its own charm. I think diversification is very important. Whether you diversify some part of your portfolio, some towards stocks and shares, some towards crypto, and so on, property and so forth. I think the beauty of the fintech platform is that you do not actually have to, I mean, with us, you don't have to actually physically own the property. You don't have the headache, but you still basically are, able to get up to 10% gross interest per annum. And this is something that was only possible. This is a new phenomenon, right? And especially with the advent of ISA for P2P platforms, that makes it even more attractive. So yes, research is important. It's all about what is your risk appetite as well as an investor, and knowing like what whether you're investing in first charge projects, second charge projects, what you're comfortable with, what type of investor you are as per the new regulatory requirement, and always knowing that when it comes to investment, the capital is always at risk, even if there is a certain layer of security.
100%. Thank you. Beautiful answer. And last but not least, and this is open to all panelists, we're talking about, let's talk about return on investment. Of course, a lot of people focus more so on the money made as opposed to the return on investment, which I think is a really important point to address as a new investor, to focus not so much more on how much money is made, but rather what return on investment they're gaining on their capital, right? So let's talk about gold. Of course, we are on the big Indian money show. A lot of people are very much invested into gold, very interested in gold as well. So what would you say in terms of this compared to other ways of actually investing? Is gold still the talk of the town? Is gold still the place to be investing? Or what would you say in terms of your own experiences would be the best route in terms of investments alongside gold, or whether or not gold is really still the best place to invest? What would all your thoughts be? Whoever would like to go first, please feel free to.
So, of course, people in India love gold. It is the Indian marriage season drives the world gold market to a large extent. My own that in the modern world, one of the virtues of gold is that it gives you an insurance against money printing by central banks. That the amount of gold in the world is limited. That compared to paper currencies, you don't have a huge supply because of printing presses. It's very hard to increase the supply of gold. The problem with gold, obviously, is that it doesn't pay you an income. It doesn't pay a dividend. It is hard to value, and you have to pay money for security and for storage. So is that we'll advise people to allocate 4 to 5% in gold, up to that. But on average, we think people can do better for their investments in other assets rather than gold.
Thank you for your answer, Sanjeev. And Vatsal, what would be your thoughts on this question?
Sure. So when it comes to macro portfolio, I take a very different approach. I like to see how the world is moving, how the money in the world is moving. So tiny bit of context over here. The way I see central banks, they are just printing money, they are taking down interest rates, and think you look at US bonds, they are being sold at a very high rate, and US central bank, they are printing money and they are buying bonds, whereas the international investors and the domestic investors, they are basically selling US bonds. And the way I see it, if US bonds go down, and if rates, even if tax increase and rates increase a little bit by 0.5 or 1%, I think stocks market are going to go down very badly. Plus, I see this is the efficient case of monetary inflation instead of simple inflation. In other words, I think this is the case of stagflation coming into picture, where inflation rises to the level, but the economy is not really moving higher, which means it's actually bad because people's cash value goes down. So I think it's going to create a very rattling effect in markets. So the way I see it right now, my macro portfolio, I have a lot of VIX positions. I have 12 to 15% of gold in my macro portfolio. Apart from that, rest of them are basically currencies positions, like I'm short Turkish lira, short Argentinian sol, and some of the hedges and cross hedges. But coming back to gold again, I think right now is the time to put 12, like as Ray Dalio says, at least 15% of gold in the portfolio. I would say, because I have VIX too, so VIX acts as a good hedge against the market faltering down. So I would say 12%, but don't go below 10%. I think gold is the key. Plus, when stagflation comes into picture, when inflation rises, the agro commodities and then even your metal, they all rise in value because they derive their majority of the part from the inflation. So I would say go for agro commodities, long agro index ETFs, and definitely long gold. So yeah, 12 to 15% gold.
Okay, fantastic. And last but not least, Arya, do you have any thoughts on this viewpoint, or anything that you'd like to add to this discussion?
I think just to kind of summarize, I think diversification is key in any sort of a portfolio, and to always do your due diligence and start small is something that I personally follow. There's also a book called Psychology of Money. So when Garg was talking about previously, very interesting point that once you do your initial analysis, it's all about like the emotion. And this book, Psychology of Money, that kind of sees like how we look at finances, how we look at investments. And it could be because how we felt about money growing up and how we associated money and investment, and so on. So that's something, it's probably worth reading that book as a beginner as well. And yeah, I think to do due diligence, understand capital at risk, and to diversify would be my personal opinion.
Absolutely fantastic. Okay, well, I think we've come to the end of this discussion. Thank you so much, panelists, for your contributions and your viewpoints. I think we've all got a much better picture on exactly what it is that we need to do before we start to become a retail investor, what we should be looking into, the fact that there are so many different platforms and different ways of actually investing. And it's important to do our research, to do our analysis, and make sure that we are gaining a consistent and holistic education to ensure that we don't become part of the 70% who lose money in these markets. So panelists, thank you so much again. I'm now going to be handing it back over to Tony.